Meanwhile, New York Fed President John Williams just saying now that slower U.S. growth is, quote, a new normal. To Raymond James, chief strategist, Jeff Saut. Jeff, good to see you. Thanks for being here. In fairness, he also said that that shouldn't be a cause for alarm. He said, and I'm quoting here, with a strong labor market, moderate growth, and no sign of any significant inflationary pressures, the baseline outlook is actually quite favorable. So he's saying, yes, slower growth, but that's not necessarily a bad thing.
I agree with that. I mean, slow growth, as long as it's, 2 to 2.5%, ought to allow earnings to come in continuing better than expected, which they've been doing for the past few years since we transitioned from an interest rate-driven secular bull market to an earnings-driven secular bull market. I think what we're involved in right here is an upside consolidation after one heck of a rally off the biggest selling climax in late December that I have seen in 48 years in this business.
Wow. It was an incredible rally. I didn't know it was that strong. But the expectations are important. The market's been down for a couple of days now. It's down about 137 right now. Expectations were built so high by President Trump and the economic team of 3% or greater. Will those expectations continue to drag down the market?
I don't think so. I think that the excesses, the overbought conditions, and a number of other finger-to-wallet indicators that got way overbought at the end of January and beginning of February have basically pulled back to neutral. They may pull back a little bit more, but I think, if the market can close, the S&P can close above 2790, I think we're going to take another stab at the 2800 to 2830 overhead resistance. I think eventually we're going to rally to it to new highs.
All right. Now, the trade barriers, and we still have them, they may be lifted. We're hoping for the best with trade talks with China. We want China to change, but also it would be a better environment if the tariffs were lifted. How badly are these trade barriers hurting growth? I mean, is what we're seeing now the slowdown in growth because of the trade barriers that have been erected over the past year or so?
I think on a short-term basis, the market's paying attention to that. But the fact of the matter is we have $55 billion in tariffs on Chinese goods. That's against a total goods trading relationship with China of roughly $530 billion. So it's around 10% of the total goods trading relationship. I think that's why the market in the intermediate term is not paying a whole lot of attention. Now, if that escalates, then you have to reappraise it. But right now, it's not that big a deal.
Jeff, to what extent are trade concerns being used as an excuse by some governments, particularly in Europe, who continue to have very high tax barriers, very high regulatory barriers? I mean, they have their own problems with putting up resistance to growth, don't they?
Yeah, I don't disagree with that. I'm not really invested in the international markets. That's not true. I own some mutual funds that play to emerging markets and frontier markets. But in Europe, I don't have much exposure because I do think they have problems over there. But what hit us was a trifecta of bad news. You had, some problems with the Chinese trade talks that were going well, and then they weren't going so well. You had forecasts of slower GDP growth. You had reduced earnings expectations. And I think that's what stalled the market in the 2800 to 2815 zone.
And finally, Jeff, you have Great Britain, our good partner for many things. Brexit is causing a lot of fear. Is that fear justified?
It probably is in the UK, but I don't think it's that impactful for the U.S. So I'm not all that worried about Brexit.
Good news. Jeff Saut, great to see you, Jeff. Thank you very much. Appreciate it.